but the state saved interest paying for the time before it was obliged to give the credit back to the central bank and sell correspondingly loans on the capital market. Therefore, there should be no objections against a direct financing by the central bank if it is in line with a monetary policy and not ordered by the state. If you consider to what a large extent for the time being the money supply is decreasing, and banks and companies, especially in industrialized countries, are calling back liquidity out of companies in less industrialized or developing countries, forcing them and their countries to collapse, the huge tasks should become clear, which have to be faced by the central banks. To meet the lack of money supply, the open market operations are an appropriate instrument. For in economic crisis, the traditional instruments to regulate the money supply don't work sufficiently. Though the central banks have lowered the interest rates for which private banks can refinance themselves to nearly 0%, not enough money has been asked for. The immense quantity of expected necessary state demand of credits may influence the credit standing of smaller and less developed states to an extent that they can only borrow at high interest rates, if so ever. Also from this point of view, it is necessary to spare the private capital market as much as possible. Nevertheless, central banks cannot do without checking the credit standing of states, communities and member countries of the Eurozone. That means, of course, in principle, the credits of central banks should be given to governments and local authorities at a very low interest rate. But the interest rate should nevertheless be dependent from the credit standing of the states or local authorities. If not within the Eurozone, criteria of credit standing are elaborated up to what amount and at what conditions credit may be granted to public authorities. By that, it can be regulated that public authorities which on the private capital market would not get money, and if only at a high interest rate, keep in line with the capacity to shoulder debts. The criteria for granting credits to public authorities should be surveyed by an independent institution. Of course, you cannot make central banks responsible for possible financial difficulties of smaller states and local authorities. But the increase of the money supply in industrialized countries will also ease the lack of liquidity in economically weaker countries, because companies in industrialized countries are not more forced to that extent to repatriate liquidity. It has also been found out who has to help when economies are breaking down. As that will tackle also the stronger countries, they also have to feel themselves responsible for weaker countries. In respect of these cases, mutual agreements must take place between governments, central banks and international organizations. That, of course, we cannot discuss here further. I only intended to stress the importance of open market operations in the form that central banks directly grant credits to the states. I have to thank my granddaughter, Paulina Martinez Moreno, for her technical assistance and you for listening. Thank you.